What's going on YouTube? It's MEQ Mondo. Welcome back to Income Architects. And in today's video, I'm going to be breaking down a quick trade of how I made $500 in just 10 minutes trading the Micro Nasdaq. I'm not just going to show you the results. I'm going to walk you through the exact trade, the confluences I looked for, as well as why I took the trade so that you can learn from it and apply it yourself. If you're trying to become more consistent and understand how to move with the market instead of chasing it, then it's the video for you. Without further ado, let's get into it. Okay, so as you guys can see, this is the trade I took here. It was about a 2.5 risk reward, which means I risked about $100 to $150 to make $500, which is good. It's a little later in the day right now, so we're gonna hop into bar replay to give you more of a live look on what I've seen in the market. Okay, so I only use one indicator. It's not really an indicator. It tells me the sessions. So the yellow is a London session, blue is Tokyo session, green is New York session. Why is this important? Because I use the highs and the lows of these sessions. So the highs of London session would be here. I mark these out. London high, a relatively equal high. Relatively equal highs mean it's a high here and a high here, and they're relatively close or level to each other. So mark out the highs and I mark out the lows of mostly London session. Asian session not so much because moves already happened. As you can see, these lows are already taken out from Asian session. They got taken out from London session, and these highs are just way too high. So I mark out these sections, and these are my key draws on liquidity. What is liquidity? Liquidity is where price is where orders lay within the markets. Orders lay within the markets. This means above highs you have sell orders, above lows you have buy orders. So oftentimes when these highs get taken out, retail traders or investors, what are they looking to do? They're looking to sell high and buy low. This is why liquidity is so important in the market. It is literally how the market moves. So I mark out my draws on liquidity, which were 3 on the Nasdaq. Let me move my webcam to the bottom because I can't see. Okay, 3 draws on the Nasdaq. London high, relatively equal highs, and then London low. And then we do the same thing for ES, which ES and Nasdaq directly correlate to one another. Well, they follow one another. So ES follows Nasdaq. Nasdaq is the faster index. So when Nasdaq's going up, ES is 9 times out of 10 going to be going up unless it's just a crazy trading day. So we mark out these highs and these lows. This low at 8:30 was a very key draw on liquidity. Why? Because like we said earlier, orders rest below this. It's a London low. It's a session low. London low, session lows. And as well as there being red folder news. News is really important when you're trading. So as there being red folder CPI news 830, which left behind this huge wick and this huge strong liquidity. So there are really two to three major draws on liquidity. You have three major draws on liquidity. And I'll get more into this liquidity stuff when I begin my boot camp soon. You have session highs and lows, which are these here: London high, London low, low, Asia high. You have news candle wicks. And you have relatively equal highs and lows. Relatively equal highs and lows mean this one right here. This is a high right on top of another high. Would you say these are relatively equal? And look, London highs are relatively equal with this high. So this is just a big draw liquidity to the upside. Down here we have London low, which is a session low, and we have a news candle wick, which is also a major draw liquidity. So price is going to want to fill those orders below these key draws on liquidity, which favored my bias on being bearish, as well as if you see the trend we are in. Let's go to 15 minute, might be easier to see. Okay, 15 minute, we are clearly in a downtrend. A downtrend is when the market is making highs, lows, lower highs, lower lows. So as you can see, we have a high, a low, a lower high, a lower low, a lower high, a lower low, a lower high, a lower low. Yep. As you can see, the market is clearly bearish, which means it's going down. So I'm looking to be a part of sales, because trend's your best friend. You always want to follow the trend. You don't want to trade against the trend. So I'll wait for market open to react. What I was looking for out of market open really was price to come take out these key areas of liquidity that we marked earlier before going lower to continue the downtrend. But let's see how it reacts. Market opens, bearish candle, but the candle closes red, but it's a bullish hammer rejection candle, which kind of threw me off at first. So we wait for more confirmation. Just because we think or we know where the market is going to go, we still have to be patient and wait for our setup to present itself. So I wait some more, and boom, just like that, price comes, takes out the draws on liquidity that we marked earlier, which means it fills those orders for those retail traders who are trying to sell, which means the market filled orders and is ready to push, should be ready to push lower. Just like that, as it sweeps, price rejects, and on the push up, On a push up, it left behind a fair value gap, which let me go back a candle so that I can show you that. On a push up to take out the liquidity, it left behind a fair value gap. What's a fair value gap? This right here. This gap right here. This gap between, we'll make it a different, yeah, we'll make it a different color. Make it yellow. Oh no, not that either. We'll make it orange. Okay. So this is a FVG, which is a fair value gap. A fair value gap is, let's break that down for you all. Fair value gap is when price moves. Price is candles. Price is just the candlesticks and how they move and what direction they move. It's when price moves to in any direction, or moves up or down aggressively, leaving behind a gap consisting, let's move this over, not consistency, consisting of 3 candles. So boom. Fair value gap is when price moves up or down aggressively, leaving behind a gap consisting of 3 candles. And when this gap is presented, it's normally used to be filled and push price higher, be filled and push price more towards that direction, or sometimes it can be inversed. So I can draw it. See here. So boom. This is a candle. Candle number 1. The wick from this candle. Number 2. It's really hard to draw. Candle number 2. Don't make fun of my candles, guys, please. Oh, it's good. Candle number 3. It's the best candle I've drawn. Oh yeah. Alright. These are candlesticks. So candle number 1, 2, and 3. They see how this gap is produced. See, I can do the rectangle again. This gap right here. This gap is produced. Fair value gap. Okay. Price tends to either come into this gap and push higher, or price sometimes comes and inverses the gap, comes back in and uses it to go lower. So with us wanting price, with us expecting price to go lower due to our bearish trend that we talked about, we want this gap to be inversed. So as price goes. It's the 1 minute time frame. As price continues and swept out these levels of liquidity we marked earlier, this session highs and these relatively equal highs. Fill in those orders for sellers so that it can go lower. So as it sweeps that liquidity, that fair value gap now turns into an inverse fair value gap. So now that you have an inverse fair value gap, this is showing that price is strongly reversing and is ready to go to the downside. Now, do we enter off just the inverse fair value gap alone? No. We wait for more confirmation, whether that be a retest, like I showed earlier, the drawing, a retest, come down, come back in, and then go lower. Or that be another fair value gap being made to the downside, and we wait for it to retest into that fair value gap, or that being, which this is normally for the premium, but I'll give this game out for free. That being price coming into a premium, which is above the 50% mark. If you guys want my Fibonacci settings, I'll give you those. Here are my Fibonacci settings if you want them. You only need 1, 2, 3, 4, 5. You only need 5 coordinates for your Fibonacci. So if we return higher than 50%, then that's a good place to sell at a more expensive price, which is called a premium. So we just wait for more confirmation. So as the market goes, which might not show too well because we're on replay mode, I'm waiting to see price return up into the zone. What is this right here? What did price make here? If you're paying attention, you know what just happened. Price right here made a fair value gap. Which will be a good place to enter. With stops above the inversion fair value gap, which is the key indicator that price is indeed reversing to go lower. Though I did not enter off this, I wanted to see price come back into a premium so that I can get a better entry or a better price so that I can risk less. That's the most important part of trading. It's the patience and not having fear of missing out. It's really hard to do, but if you can do it, you can be a successful trader. So with that being said, price drops. What does it do here? Price returns right into that level we marked, that inverse value gap we marked out earlier, right into that level. And if we get rid of some of this mess, so you can see, get rid of the trading zones, because you understand that now. As you can see, it's above premium. It's in premium. So now we're looking to enter. We're looking to enter into shorts. What are we shorting into? That news candle wick and that London session wick, that London session low. We're shorting into that because that's a key draw on liquidity. That's where buyers or investors want price to go in order for them to have a cheaper entry. So to fill that orders and push price higher. So we know price wants to go there. So we set up our trade. So we enter our trade and we capitalize on what we're seeing the market do. So we're going to enter short here because that's where the candle closed. We're going to put our stops above Still gonna put our stops above the fair value gap, or the inverse fair value gap from earlier. Let's remark that, just in case you forgot where that was. Inverse fair value gap. Make this a different color so you can see a little better. Sorry about that. Let's do dark blue. Yep. So this is the inverse fair value gap. So, okay. That was dumb. But that's the inverse fair value gap, and this is above the 50% mark of this down move, which is indicating that it is above, it is in premium, which is a good price for us to sell as sellers, because that's what we want to be right now. We want to sell. So we enter this trade targeting these lows. Targeting these lows. And what I like to do is have multiple take profits so that I can take profit and minimize risk as I'm trading. So with that being said, this will be my first take profit, because what are these? What are these two? Relatively equal lows. This just, it's that easy. So I'm going to target these first relatively equal lows, and I'm going to target these London lows as well. So instead of having this, actually, I can show you exactly what it looked like when I did it. So we're going to sell 4 units, right? Stop loss above here. Take profit down here. See, I think I put too many contracts. Yep, put too many contracts. I did 3 contracts. 3. Sell. Okay. Stop loss above here. Take profit. Rest it below here. And now we watch the trade play out. So as the market moves, at this first take profit, I like to take partials. Partials are just taking, I have 3 contracts, so I take off 2. So I take off 2 contracts, which means I will buy because we're currently in a sale. So I buy 2 contracts, and boom. Now I can make my trade risk-free, which you want to do as quickly as possible. It's not confirming. Have a risk-free trade. So now we can let price just do its thing. Just like that. You have a full take profit, which is, if I look at my replay trading, which leads to me making, as you can see, the total P&L in the corner, $500, $517 off that trade with minimal risk. So if you enjoyed this video and want more setups like these, make sure you like the video, subscribe to the YouTube channel, and turn on post notifications so that you never miss future setups. Also, if you want to see these setups in live time and be a part of the community, make sure you join the Income Architects Discord in the link down below. Drop a comment if you have any questions or want me to break down a specific concept next. I'll see you in the next one. Peace.